Hey everybody, welcome back. I decided to do a quick video about a topic that I was helping a prospective client with yesterday, and she just took to it so well. And I've been getting a lot of clients, potential clients, asking me questions about everybody's favorite subject, credit. So let's just talk a little bit about credit, what goes into your credit score, and maybe some things you need to do to get your credit in a better place. Now, one disclaimer I do want to put out there: I am in no way, shape, or form recommended that if you don't have a credit card to get a credit card. If you have credit cards to get more, I am not pushing that this is what you need to do. What I'm simply doing is telling you how our country's system uses what credit lines you do have to evaluate your credit score. So let's just get that, I'm not a personal advisor. I'm just kind of giving you how it typically works. And I'm not recommending that you take out a bunch of credit cards because I actually not a big fan. So anyway, this is the chart that I have, and this is from FICO's website. I think this is great. This is pretty accurate. If you Google what goes into a credit score, this is basically what you're going to see. So let's get right into it. Let's start with the big guys. Amounts owed. That's about 30% of what goes into your credit score. So what does that mean? Amounts owed. Let's say you have a credit card and your limit is $1,000. Credit bureaus typically like to see that you are using about 15 to 30% of your total credit. So that means if you have a credit card for $1,000, they want to see that you are only using at the max 30%, which would be about $300. And you can say, well, actually, my credit card company lets me go up to $1,000. That's my credit limit. Yes, that is your credit limit, and you can spend that $1,000. But the closer you get to that $1,000 mark, each month that your credit card company is reporting that to the credit bureaus, the credit bureaus are looking at that and saying, he or she is depending more and more on that credit card. The closer they get to that number, we're going to, take some dings off for them. So just keep that in mind. Just because you have a credit card, it does not mean you should max it out. Like I said, they typically like to see 15 to 20%. So that's what the amounts owed is. Your car or car payment, it works a little different. Not going to get into that, but basically the lower your car payment, the better. Let's talk about the next subject. Big portion of here. Payment history. What does that mean? That means anything that's on your credit report, are you paying it on time? As you can see, that is probably the biggest chunk, typically of your credit score. If I borrow you money, do you pay me on time? I'm not talking about your cell phone bill, unless it's on your credit. I'm not talking about your gas bill, your water bill, your trash bill. These are things that are on your credit as open, active accounts. Are you paying them on time every month? So, the general rule of thumb is that if you are not paying things on time, your credit worthiness goes down. So if you get a late payment on your credit, it can stay on there for up to 3 or 4 years. Now, if you do have one on there, don't beat yourself up. Over time, they do become less and less of an impact on your credit score. But my advice to you is not to get any more. That is probably the most important thing because there's not a lot you can do to come back from a late payment. If you do charge your credit card up high one month, you can pay it off the next month and get back on track. But once they put that late payment on there, that's it. It's going to be there for 3 or 4 years. If you have any late payments that's on there, make sure they're right because that is a huge hindrance. And like I said, if you do have some on there, don't beat yourself up. If it was from 2 years ago, chances are it's not still hindering your credit score. It's just there. Okay, so let's look at what's next. 10% is about new credit. What does that mean? That means that new what you're applying for. So if you start applying for a bunch of credit cards or a bunch of car loans, that's what they're talking about. Don't apply for too many things unless you know you're going to get approved. Now, when you apply for a home mortgage, it is expected that you shop around. So the rule of thumb, once again, I'm not an expert, but the rule of thumb is if you apply for any line of credit, like a car or a mortgage, credit bureaus see that you are comparing rates. So if they see you apply today, tomorrow, and maybe next week, they're kind of, even though it's going to go on your credit report, they're only going to ding that as one ish because they know you're shopping around for something like a mortgage. But if you go out and apply for 10 different credit cards, I don't really think it's the same for that. I think it's more about mortgages and maybe other huge purchases, but not 100% sure how it works. But so it's expected for you to shop around. Don't be scared to shop around because it's going to ultimately save you thousands in the end. But new credit. So don't just go out applying for stuff just because you're bored and you want to see if you're going to get approved. Make sure you have a good chance of getting approved. It's something you need. Not a personal advisor, but just kind of telling you about that. Length of credit history. So that's just saying that 15% of your credit score is how long you've had credit. Your oldest account you should be able to pull up on your credit report. It's about how long have you had that credit. So, I'm no way, shape, or form recommending you go out and sign your kids up for a credit card at 15 or 16. That's really non-controllable. People open their first lines of credit, which can be which is even like a student loan, just at different times in life. There's really nothing you could do about that. As time goes on, your credit age gets, higher, and that's why, a lot of older people get approved for higher limits because you have a strong credit age. But I think once you get to 8, 9, 10 years, I think it's considered strong. So can't really change that one that much. It's just kind of a time thing. 10% says types of credit in use. So that just means they don't want 100% of the credit on your credit report to be credit cards. They don't want it to be 100% student loans. They don't want it to be 100% mortgage. So once again, I'm not recommend that you go out and apply for all these things, but they take into account, you pay your credit cards on time, but you don't pay your mortgage on time. Or you pay your mortgage on time, you don't pay your credit cards on time. So they want to see that no matter what line of credit you get, that you are consistently going to pay on time. So that is just a quick little synopsis about credit. It's just a general guideline. Some of these percentages are not exact, but I will say these two are definitely correct. Payment history, amounts owed. FICA is a great website, to get credit. There's a lot of stuff out there about credit. Just make sure you're getting it from credible sources. But at the end of the day, if you want to know about your credit and you want to know how to get your credit to where it needs to be, the best thing to do is to either talk to a real estate agent or have a loan officer that you know and trust pull your credit for you and look at what you have and give you some guidance on what you need to do to get it where you want to be. So I hope that helps. I'm going to use this video to send to a lot of my clients because a lot of people have questions about it. If you need a copy of this, you should be able to Google what is in a credit report and you'll find it. Otherwise, DM me, email me, message me, whatever, and I'll send you a copy. So thank you so much, and I hope you enjoyed this video.